Hey, it's Lewis here and welcome back to the channel, and in today's video we're going to be going through British American Tobacco stock. We'll be using fundamental analysis via TIKR terminal to go through the financials, and then we'll see if the business is of good quality by putting the numbers into my analysis checklist. After this we will put the free cash flow into my DCF and we will come to a fair value of their stock. Let's get straight into it. So who are British American Tobacco? So BAT is a British multinational company that manufactures and sells cigarettes, tobacco and other nicotine products. The company itself was established in 1902 and it's headquartered in London, England. As of 2019 it was the largest tobacco company in the world. So it's got all sorts of different brands, operates in 180 countries. It's got Dunhill, Kent, Lucky Strike, Pall Mall and Rothmans. Also the vape brands include Vibe, Infuse and Glow. So the company itself has got a primary list in the London Stock Exchange and it's a constituent of the FTSE 100 index. Now let's have a look at the sales for British American Tobacco, and we'll start with the sales per business. So in 2021 the combustibles made up 86% of the business's sales. So basically normal cigarettes, simple as really, most of the sales come from cigarettes. Then the rest of it comes up as traditional oral 4%, vapor 4%, heating products 3%, then the rest is the rest of it. So basically most of it is made up of combustible cigarettes, just the usual standard cigs, and the rest of it is the more newer stuff such as your vaping and maybe your nicotine patches and whatever it is, but they don't make up that much of the revenue. But then sales per region, so 46% of sales come from the United States, Europe makes up 23%, Asia Pacific and Middle East makes 16%, Americas and Africa 15%, and then not even 1% is made up of the UK. Quite funny that, hence I've got British in the name, but not even 1% of the sales come from the UK. Interesting, but you know, BAT are a global company, not just British, as the sales show. Now let's have a look at the financials for British American Tobacco, and we will start with the income statement as always. So from 2016 to 2021, the sales have gone up by a fairly decent amount. As you can see here, in 2017 had a massive jump of 38%. This wasn't because British American Tobacco has just grown this much. They have acquired someone basically. They acquired Newport cigarettes for using debt and cash equity, whatever. They bought another business and they've made their business bigger, hence why the large increase in sales. So yeah, sales for tobacco companies are generally just single digit slow growth, so nothing spectacular, but that's just something to point out there when you're looking into these guys, because you'd suddenly think, oh, they've grown massively out of nowhere, but that is the reason. You can Google it and look through the 10k, or go on Company's House if you're looking at the UK accounts. But yeah, anyway, so yeah, the sales, apart from the acquisition, are just so slow single digit growth. Well, apart from 2020 and 2021, just no growth, or slightly decrease in growth. Basically means that when we do our analysis, we can't really expect much growth going forward. That's just my view. I think that's a prudent approach to take anyway. So anyway, you can probably see that these businesses, tobacco businesses, are very profitable. These gross margins are very high, 80% gross margins. It's like a software business, isn't it? Crazy stuff, but okay, we'll get to the net income. They're very profitable businesses, tobacco. You can see the net income margins are solid, like that's the anomaly, 191%, that's just wrong, because of the acquisition, some weird accounting thing. But yeah, so mid to high 20s, often fairly decent. But yeah, we'll look at the shares outstanding now, and you can see 2017 and 2018, the shares outstanding increased slightly, and then from there they've remained pretty much stable, not increased by much, probably employee stock options, which is fair enough. Okay, balance sheet time, and what's the cash balance doing? Not much. Long-term debt wise, yeah, big increase in long-term debt here from 2017 for the acquisition they made, which is fair enough. They've acquired a business to make their business bigger and better. And then from there, you can see if they've started paying it down. So that's a really good sign. If they just kept on increasing that long-term debt for no reason, massive red flags. But they've used debt to make an acquisition and they're now repaying it. So I quite like that personally. Return earnings, you can see here just a massive increase there to do with the acquisition and the accounting rules, etc. But you can see just slowly increasing return earnings. We love to see that. Cash flow statement, so cash flow from operations minus capex is free cash flow, and this is known as owner's earnings. The most important figure I think it is anyway, in value investing is free cash flow. You just want this figure to be going up over time. So post acquisition, it's not really done much, has it? So 2018 had a really good year, 2019 had quite a bad year, and then from there it's just stayed pretty much the same. So like I say, you can't expect much growth from this business. Debt repaid, repaying all that debt. Dividends, tobacco companies are known for the dividends, increasing the dividend over time. Repurchase of shares, probably to counteract the small employee stock options. So yeah, onto the ratio. So why do I like the ratio so much? Because it tells me a story of the business. So we'll have a look at the return on capital, and it's a little bit low for what I like to see. I like to see about 15%, but we'll see me average in a minute. But yeah, past 2 years has been about 9%. So not too bad, but there is better out there, let's be honest. Right, okay, so margins we've spoken about, very high. Net margins as well, and free cash flow margins are there, so really, really good. Current ratio is below 1, which is a bit bad. It might be industry specific, but maybe something you can take on the chin. Cash conversion cycle has been going down and down, which is a good sign. Maybe getting the cash in quicker, which is a good thing. Total debt to capital is 32%, so yeah, below the 50% I like to see. So yeah, interesting stuff there from TIKR. If you want to use TIKR terminal, go into the link in the description down below. Click the link, sign up, and yeah, have fun using TIKR terminal. If you are enjoying today's video, then why don't you book in a one-to-one coaching session with myself? In these sessions, you will learn how to analyse a company using fundamental analysis. As well as this, you will learn how to value a company using a DCF model. Value investing is the art of buying stocks which trade at a significant discount to intrinsic value. Value investors like myself achieve this by looking for companies on cheap valuation metrics, typically lower multiples of their profits, assets, and cash flow as well, for reasons which are not justified over the long term. Billionaire value investors such as Warren Buffett, Charlie Munger, and Joel Greenblatt have all used these timeless concepts to beat the market over the long term. No financial advice will be given on these calls, financial statement analysis and business valuation, education only. I will see you there. Now let's have a look at the genuine impact stats for British American Tobacco, and we will first start with the quality metrics. So it's currently showing as low, so profitability medium, financial strength weak, capital allocation sound. So a mix between these is making it look low. On the quality rankings, a lot of it's maybe to do with the debt. I'd say the profitability is there, but it's maybe quite a bit better out there on the GI platform. Then looking at value, it's looking very cheap, which is what we like to see on this channel as value investors. Income statement cheap, balance sheet cheap, cash flow very cheap. If we can buy something for a cheap / fair price, we will increase our returns over the long term. So that's something just to bear in mind when we get further into this video. Historical growth low, to be expected. It's a tobacco company. It might grow its sales with inflation. Well, you want it to grow its sales with inflation, and then you'd be very happy. Now let's have a look at the analysis checklist for British American Tobacco, and we will start with my first pillar. So profitable, high returns on capital using low leverage. So yeah, returns on capital 8% average over the past 5 years. Not quite the 15% I like to see, which is a bit of a shame to be honest, because if it did have high returns on capital, you'd be a lot happier as an investor. I do expect this to go up over time if they repay their debt. If they'll repay the debt and if they can make the same amount of profit, then in theory the return on capital will get higher, which is something you would like to see. Gross profit margin 81%, 5-year average, lovely stuff. Net profit margin, that's a bit of an anomaly, 58%. So we'll go here where the data is pulled from in 2017 at 192%. Basically ignore that if you want. Whatever the average of that is what you want to be looking at. So just from the top of my head, probably 24%. So that's an anomaly. Yeah, I should have left out for anomaly, but hey ho, let's just say it's 20%. Highly profitable. Free cash flow margin, there we go, about 25%. So yeah, lovely stuff there. Current ratio is not above 1, unfortunately. I think this is an industry problem. If you look at Philip Morris or Altria, you'll see the same thing. So you can maybe take on the chin a bit more. Cash conversion cycle is not above 60. Maybe industry thing again, but just something to bear in mind. Total debt to capital is below the 50%, so we love that. Proven ability to grow, all of them in the green. Revenue growth, net income growth, return earnings growth and free cash flow growth. Like we said previously, the acquisition will have a lot to do with this, but for my quick analysis, it's all in the green, which is good. Capital allocation, so what are they doing to reward us as shareholders? What are they using the cash to do? Long-term debt repayment, they're starting to repay the debts from the acquisition, which is awesome. Decreasing share count over the past 5 years is increased, which is not a good thing. There's reasons for it. Like I said, acquisition, use a bit of shares to do that. You can maybe deal with that, because if that's the case, we're not just issuing shares to finance the business. Dividend growth, being a tobacco company, you expect this to be in the green, and it is. Good acquisitions, looks like we've made quite a few write-offs. Could be for many reasons, but something to look into, because you don't want them writing off all sorts of different things. Something to look into in the financial statements. Buy at a fair price, so the most important pillar in my view is buy at a fair price, because this is where you secure your return. PE ratio is currently 12 and price to free cash flow is currently 10, so quite cheap based on the market average. DCF valuation for 10% return, looking at a share price of about £50 per share. That's in GBX, so that's in pence. Current share price is, about nearly £33.50, so we're looking at an uplift of 51% to the fair value. So we'll have a look at the DCF now, and British American Tobacco free cash flow estimated from marketscreener.com. It's shown that it's going to decrease next year. So it's basically going to stay pretty similar, if not decrease. So yeah, 10% return, we come to a share price of £50 per share. Quite interesting, because if you can just maintain free cash flow with inflation, it's looking like a decent deal. If we put 15% in there, into a share price of £30, which is, a 10% drop away. So yeah, if you want a bit of a margin of safety with this one, maybe use a higher required rate of return, with it being a tobacco company, a lot more risk involved, regulation and all that stuff. But yeah, there's no denying it looks cheap on a valuation basis. Yeah, it's got decent looking metrics on here. Maybe returns on capital could be higher, but you can't have everything, can you, when you're looking at a company? I think because it's so cheap, I think it's worth a look at for any value investor, but that's just my view. So there we have it, that was my full stock analysis for BAT, and if you enjoyed today's video then please subscribe to the channel. Thank you very much for watching, I will see you next time.
Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.